The last unusual phenomenon has emerged just before Trump's inauguration. The critical moment has arrived. Brace yourself. If we miss this chance, a fixed amount of real cash flow will drain away each year, relentlessly driving asset prices skyward, while cash steadily loses its value. Time is running out. Why? Because a final anomaly has surfaced when the U.S. lowers interest rates. Economic theory suggests the U.S. dollar should weaken, yet it grows stronger instead. What does this signal? It suggests that when economic principles no longer apply, the risk of a financial crisis akin to 2008 spikes. Is this truly happening? Greetings from the FortuneCraft channel. In fact, we saw this play out in 2020 during the pandemic's onset. What do I mean? The U.S. stock market crashed so severely that trading halts were triggered. Sales were blocked because the drop was steeper than a freefall. They paused to stabilize cash flow. So where did the money come from? Unlimited balance sheet expansion, pumping funds into the market to prop up asset prices. This forcibly delayed a financial catastrophe of that scale for 4 more years. At first, this seemed positive. People kept earning and enjoying life. But now, Americans are fed up. Despite rising stock and real estate values, they used their votes to bring back former President Trump, rejecting the capitalist-backed Democratic Party. What does this reveal? It's like dumping a current partner, but refusing a new one, longing instead for an ex. Through their votes, Americans are signaling that despite a glossy economic facade, their lives aren't improving. Otherwise, why yearn for the past? For capitalists, there's no incentive to postpone the reckoning any longer. Why keep up the charade? When Trump, the capitalist, disliked wildcard, it was like a class electing the student most despised by teachers as president. He'll inherit gifts upon taking office in January. A stock market at record highs and U.S. bonds at historic lows. Normally, lower interest rates mean bank deposits earn less, prompting wealthy individuals to withdraw funds. With cheaper borrowing rates, they'd borrow from banks to buy U.S. bonds, pocketing the interest rate spread with minimal effort. This boosts bond demand, raising prices and lowering yields. If you're a savvy investor, expecting bond prices to climb and yields to drop, you'd buy early, locking in high yields when prices are low, then selling at a profit later, or holding for steady returns. But here's the twist. Despite attractive yields and cheap bond prices, fewer people are buying. This means fewer are willing to lend to the U.S. Previously, rising rates tanked bond prices. Now, even with rate cuts, bond prices still fall, and long-term bonds sit unsold. Meanwhile, the U.S. stock market surged post-Trump's election. As fewer lend to the U.S., stocks climb higher still. So, what happens when Trump takes the helm? Will he keep inflating the stock market while bonds languish, or will he burst the stock bubble to steer cash back into bonds? If both stocks and bonds become untradeable, what's America's fate? Recall 2008, the U.S. stock market plunged 23.8%, and bonds were dumped en masse. A dual collapse. When that strikes, most become victims. But if we prepare and grasp the implications, 2 scenarios emerge. First, if nothing happens, fantastic, we keep profiting as usual. Second, if a crisis hits, we could not only escape but double or triple our assets. Look at 2008, Warren Buffett, armed with a massive cash hoard, bought at the bottom, multiplying his wealth several times over. Today, he's sitting on an even larger cash pile, far bigger than in 2008. Who is Buffett? He manages an investment fund in insurance companies. Insurance firms profit from client premiums, which they invest. Investment funds earn through management fees and a cut of client gains. Holding cash instead of stocks is costly. Yet Buffett's doing it, sticking to short-term, 3-month U.S. bonds over stocks. What does he foresee? If you don't want to be a pawn or victim, or even aim to seize this chance to break through social barriers, follow my channel. I'll share more vital insights soon. Worried you'll lose motivation after watching? Like this video. It'll save to your playlist for easy revisiting and action. Many argue we must track Federal Reserve rate hikes or cuts as they drive U.S. stock market swings. But have you noticed, earlier this year, when rates rose, U.S. stocks like the S&P 500 ETF still soared. When rates fell, Tesla's stock rocketed too. Up or down, the market climbs. Do rates even matter anymore? Here's the truth. The U.S. stock market thrives on free money. What's that mean? Are U.S. borrowing rates high? You might not realize this, but most Americans love borrowing, not for stocks, real estate, cars, or luxury goods, but to repay student loans. More Americans attend college now than ever. A degree today is like a high school diploma decades ago, the bare minimum for a job, yet tuition has ballooned. Why do people keep enrolling despite the cost? Government-backed student loans promise to elevate a generation's knowledge and fate. I once dreamed of studying in the U.S. A few years back, I met an American chiropractor, thrilled with his income, grateful his education landed him a solid job. Digging deeper, I learned he graduated with $200,000 at it, still pays $40,000 yearly, and feels fortunate. His loans at 6%, while his wife and friends face up to 8%. I was floored. What's the takeaway? Miss a $40,000 payment, and his credit tanks. No house or car loans later. Pay it, and he's left with little to invest. This is the average American's reality. Borrowing to service debt. Rate shifts barely affect their stock buying power. Those with student loans, mortgages, or car payments have scant cash to invest, let alone borrow more for stocks. Yet the market keeps rising. Why? The real players borrowing for stocks pay no interest. In 2008 and 2009, when the economy faltered, the Fed slashed rates to zero and flooded the system with cash, essentially limitless, interest-free loans. But this didn't reach the $50,000 a year worker. It went to giant corporations. Why? Textbooks claim that in a recession, low rates let businesses borrow cheaply to operate, hire, raise wages, or launch projects. If all firms do this, the economy revives, profits grow, and stocks rise. In theory, zero-interest loans spur production and recovery. But if you're a CEO, would you sink free money into a business during a downturn? When customers can't buy, would you expand, hire, or invest? It's like opening a restaurant mid-pandemic with everyone locked indoors. You'd bleed cash. Even with a $1 billion interest-free loan, betting on business in a recession could flop. As a CEO, your duty is to enrich shareholders, not necessarily the company. Odd as it sounds, boosting shareholder value doesn't require stellar business, just a higher stock price. With free money, the sharp move is to buy back your company's stock. Simple math. If your firm has 1 million shares at $50 each, it's worth $50 million. Buy back 500,000 in with 500,000 left. The value holds at $50 million. Stock price jumps to 100. Voila. If that's murky, here's the crux. Free money buys back heaps of stock, hiking demand, and slashing supply, pushing prices up. Shareholders cash in. They're thrilled. And you, the CEO score a fatter bonus. If you own stock, you profit too. Why bother hiring or expanding? This explains 2020, when the pandemic tanked the market and trading halted repeatedly. The Fed cut rates to zero and pumped limitless cash. Most flowed to big corporations, whose CEOs used it to repurchase stock. Result: the market rebounded from lows and kept hitting highs. Meanwhile, U.S. bond issuance soared as the Fed fueled the system. In essence, the U.S. borrowed for corporations, lent them free money, and they inflated stock prices. Shareholders won. The U.S. piled on debt. Clearly, rate cuts and money pumps juice the stock market. But the winners are big shareholders. Ordinary folks see little gain. If I'm profiting from stocks, why share with the struggling? Post-pandemic, many Americans lost jobs. Now plenty juggle gigs to scrape by. That's why Trump's support surged. Votes scream that. 4 years on, people are suffering. It's not over. After CEOs and shareholders reaped massive gains, they splurged on art, luxury goods, and more, inflating those prices via insider trades. Why? Artworks, secure loans at just 1.25% interest, near free cash. They profit, buy art, pump its value, borrow against it, and keep trading stocks or shorting them. At 1.25% it's a steal. Bank savings yield over 3%. Lose money trading? No sweat. Let the bank take the art. Their lifestyle, mansions, cars, CEO perks, stays intact. They just lose a painting. The U.S. stock market's rise hinges on free money flowing to big firms for buybacks. Analysts predict tightening credit will tank stocks. Others dissect profits, valuations, or fundamentals, deeming stocks overpriced. Some firms lose money, yet they sit out and the market climbs. The rally runs a month, a year, 2 years. Skeptics watch, too timid to join. When it corrects, say, $100 to $50, they buy, thinking it's a steal, only for it to hit then $10, trapping them. Even at $10, recovery could take years. Look at Alibaba. Same tale. They miss the boom, lose when they dive in, and stay stuck. Here's the key. Today's stock market isn't about company quality. Weak firms soar if free money props them up. Trends trump analysis. Analysis beats guesses. And systems, risk and expectation rules outrank trends. We don't just play high-odds games. We chase high-reward ones. Why does the market rise? Despite tight credit and high rates, free money still feeds speculators. Japan's 0% rates let investors borrow yen cheaply for U.S. stocks. When Japan tightened, the yen rose, the dollar fell, and borrowers sold U.S. stocks to repay, crashing the market. Nasdaq dropped 2.5% in 3 days. Japan backed off rate hikes. Even with U.S. rate cuts narrowing the gap, yen borrowing for U.S. stocks persists. Japan won't tighten. The playbook's alive. Though the U.S. cut rates, the dollar holds firm. Why? As other currencies sink, the dollar rises relatively. Rate cuts should spur outflows. But with global currencies tanking, money stays or flows. Biden's financial backers prop the dollar this way. Now global currencies plummet against it. It's not just stable, it's gaining. Capital isn't just lingering. More's pouring in. It's a crowded lane. A big clash looms. Why did I predict in early 2024 that U.S. assets might collapse under Trump? Listen. George Soros, quiet for years, is reportedly back. His team's shorting U.S. bonds with real cash. Yes, Soros, who typically shorts foreign assets into crises, is targeting U.S. bonds. Why? He represents U.S. capitalists, linked to European elites who despise Trump. This ties to recent stock dips, despite rate cuts. If true, history guides my next call. If bonds keep getting shorted and dumped, banks holding long-term bonds, like Silicon Valley Bank, will lose big or fail. Capital might then flood stocks. Buffett's been selling Apple and Bank of America at peaks. This bond shorting could herd money into stocks, letting capitalists exit at highs. Notice, stocks rise on low volume. No sellers. Falls bring high volume, sellers overwhelm buyers, crashing prices. Big players are quietly cashing out. Before U.S. rate hikes drew funds from Europe, Japan, Korea, Taiwan, Hong Kong. Now Buffett's sold at tops. Buyers persist, yet no crash. A 2008 redux. If global cash floods U.S. stocks, then they tank. It's a vacuum for world capital. Post-crash, Trump inherits chaos. If stocks and bonds both collapse, he or anyone can only beg capitalists to expand the Fed's balance sheet and pump cash. The cycle repeats. The U.S. borrows, hands free money to capitalists to buy cheap assets, and they end up owning America. Who'll really run the show then? It happened in 2008 last year. Failed banks worth $100 billion sold for $1 billion, bought with near-zero Fed loans, not personal funds. For investors, the real profit isn't in rising markets. It's in brutal, short the market. Then use near-zero loans to buy assets at rock bottom. After, set prices and push them up together. I've covered real estate and cash flow assets before. Won't repeat it. Now I use small funds for quick stock trades. Guerrilla-style hit and run. In cards, I take small wins and cash out fast, not chasing big pots. The market's a concert nearing its end. Linger, and you're trapped in the exit crowd. When stocks crash, you sell cheap. Leave early or wait out the rush. Buffett exited early. I'm in and out, grabbing small gains, often active, flexible, with big cash, to bolt anytime. Like combat, strike, retreat, they can't pin me. That's my game now. For gold ETFs, I've taken short-term profits and stepped back, but I still buy physical gold regularly. War risks and dollar devaluation loom larger. Gold's my plan B. No big profit hopes. Family buys it for me. I watch gold ETFs for re-entry chances. For stocks, we filter out duds, monitor the rest, and auto-buy at sweet spots. Systems matter. Picking stocks on gut, sans rules, is a needle in haystack mess. Time-sucking, flop-prone. They buy, it drops, or it rises then crashes fast. Stock picking demands structure. I predict, post-Trump's January start, timed bombs will detonate. My strategy won't waver. If it's shaky, I'll go guerrilla or hold cash for opportunities. Time's tight, so I'll close. I'll keep dropping free insights on wealth, investing, and financial freedom. Don't miss out. Subscribe, hit the bell, share this, poll likers. I wish you financial freedom soon. If you gleaned one or two life-improving nuggets here, I'm glad. I'm FortuneCraft. See you next video. Goodbye.